China has just intensified its sales of U.S. Treasuries, reducing holdings to the lowest level in 17 years at $688 billion as of October 2025. But here's the escalating concern that's dominating financial headlines. This ongoing divestment, combined with America's record-high debt and massive borrowing needs, is contributing to the tightest liquidity conditions the U.S. has experienced in decades. Yields are remaining stubbornly high. Markets are showing signs of strain. And a growing number of economists warn this could evolve into the most severe liquidity challenge in modern U.S. history. The controversy at the heart of it all, is this China's deliberate strategy to reduce dollar dependence and reshape global finance, or an unintended consequence that could spiral into a broader crisis affecting everyone? The data shows clear trends. The implications are far-reaching and complex. Let's examine this development from its earliest roots to its current state, because understanding the full picture could be essential for navigating what comes next in global economics. What exactly is happening with China's Treasury holdings, and why is it raising such serious alarms across Wall Street and Washington? To fully appreciate the gravity of this situation, we need to explore the long and deeply intertwined economic relationship between the United States and China, a partnership that has been both mutually beneficial and increasingly fraught with tension over the past 2 decades. For many years, China has been the largest foreign holder of U.S. government debt, accumulating treasuries as a way to recycle its enormous trade surpluses and manage the value of the yuan against the dollar. This arrangement created a delicate but powerful symbiosis. China provided steady demand for U.S. bonds, helping keep American borrowing costs low and supporting consumer spending and government deficits, while the United States offered a massive market for Chinese manufactured goods and a safe place for China to park its export earnings. The relationship reached its peak in the early 2010s, when China's Treasury holdings exceeded $1.3 trillion. But dynamics began to shift gradually. Leaders like Xi Jinping placed greater emphasis on high-quality development and reducing reliance on the U.S. dollar in international trade. U.S. officials, including Treasury secretaries from both parties, expressed growing concerns about overdependence on a single foreign buyer for U.S. debt financing. Past events like the 2018 trade war under President Trump set important precedents for retaliatory economic measures. Tariffs were imposed on hundreds of billions in goods. China responded in kind. Treasury holdings fluctuated but remained substantial. But the trend in 2025? It's a steady and deliberate reduction that's coinciding with America's fiscal challenges in ways that are raising red flags across the financial world. The twist? China's sales are part of a broader diversification strategy that includes increasing gold reserves, promoting the yuan in bilateral trade agreements, and strengthening ties with BRICS nations. More on that soon. It's the strategic element that's prompting questions about potential liquidity impacts on the U.S. side. History is rich with examples of how actions by major foreign holders can influence U.S. debt markets and liquidity conditions. In the 1980s, Japan was the largest foreign holder of U.S. Treasuries during its economic bubble era. As Japan faced its own asset bubble burst in the early 1990s, its holdings stabilized, but the impact on U.S. yields was limited because domestic demand remained strong. In 2008, during the global financial crisis triggered by the subprime mortgage meltdown, foreign holders like China actually increased their purchases of U.S. Treasuries as a safe haven asset, helping to keep American borrowing costs low amid massive bailouts and stimulus programs. The Federal Reserve's quantitative easing initiative bought trillions in bonds, providing additional support to liquidity. In 2018, during the height of the U.S. foreign-China trade war, China reduced its Treasury holdings modestly in response to tariffs, but the overall impact was contained because other buyers stepped in and the Fed was still in an accommodative stance. But 2025 feels different in several key ways. U.S. gross debt has ballooned to $38 trillion. Annual interest payments on the debt are approaching $1 trillion. The Federal Reserve has ended its quantitative easing programs and normalized interest rates to combat persistent inflation. Foreign holdings of treasuries as a percentage of total outstanding debt are declining. China's reduction from $1.1 trillion to $688 billion by late 2025 is part of this broader shift in global reserve management. The tease, is this just prudent diversification on China's part, or something with more strategic intent? Hold on. The origins reveal the full buildup. How did this situation develop into a potential liquidity concern? The origins trace all the way back to 2020, when the global health crisis disrupted trade patterns and set in motion changes that are still playing out today. The United States launched massive stimulus programs, totaling trillions of dollars to support households and businesses during lockdowns. China, recovering faster from the initial wave, saw its exports surge as the world demanded goods for remote work, home improvement, and medical supplies. China's trade surplus ballooned to record levels, reaching over $500 billion in some years. It continued buying U.S. Treasuries, with holdings peaking around $1.1 trillion. But underlying tensions were rising. The U.S. imposed restrictions on technology exports to Chinese firms like Huawei, citing national security concerns. China responded by emphasizing technological self-reliance and beginning to diversify its foreign exchange reserves away from dollar assets. By 2023, discussions about de-dollarization gained significant traction within BRICS nations: Brazil, Russia, India, China, and South Africa. They explored alternatives to the dollar for trade settlement and reserve currencies. China increased its gold purchases dramatically and promoted the yuan in bilateral trade agreements with countries like Brazil and Argentina. But the real acceleration in Treasury sales? It coincided with renewed U.S. actions in 2025, including additional tariffs on Chinese electric vehicles and semiconductors under national security and unfair trade practice arguments. China responded with measured but consistent sales of Treasuries, reducing exposure while maintaining stability in its own markets. But what next? A gradual reduction that financial markets have been monitoring closely for signs of stress. The rise in concern built over several years, layer by layer. In 2024, U.S. gross debt crossed $35 trillion for the first time. The Federal Reserve maintained higher interest rates to combat persistent inflation that proved stickier than expected. China's Treasury holdings began a steady decline, falling by several $100 billion over the year as part of its diversification strategy. Markets adjusted gradually at first. Treasury yields rose modestly but remained in a manageable range. Other buyers, domestic institutions, pension funds, and foreign allies like Japan and the United Kingdom, absorbed some of the supply. Liquidity in bond markets was adequate, with auctions clearing without major issues. But 2025 brought a new phase of intensity. Monthly sales averaged $10 to $20 billion early in the year. Holdings fell below $1 trillion for the first time in years. Yields remained in the 4 to 5% range, higher than the near zero levels of the pandemic era. Corporate borrowing costs increased accordingly. Some issuance in lower-rated segments slowed, but the breaking point hasn't been a single dramatic dump that freezes markets. It's the cumulative effect of ongoing sales combined with other factors like domestic political debates over the debt ceiling, elevated U.S. borrowing needs to fund $2 trillion annual deficits, and global risk aversion amid geopolitical tensions. Markets have seen periods of volatility, with occasional sharp moves in yields, but no full-blown liquidity freeze comparable to 2008. The fallout has been felt in several interconnected areas of the economy. Treasury yields have stayed elevated compared to the ultra-low levels of the pandemic era, making government borrowing more expensive and adding pressure to the federal budget as interest payments approach $1 trillion annually. Corporate bond spreads have widened slightly, increasing costs for companies looking to issue debt for investment or refinancing. Stock markets have experienced bouts of volatility as higher rates pressure valuations, particularly in growth sectors. Small businesses have reported tighter credit conditions when seeking loans from banks. Global effects have included higher yields in Europe as investors demand more compensation for risk, and capital outflows from emerging markets as investors seek safety in developed markets. But the twist that's providing some balance: China's own economy has shown resilience through domestic stimulus measures, with the yuan strengthening modestly against the dollar and export growth to non-U.S. markets supporting stability. Attempts to address the situation have been multifaceted but face limitations. The Federal Reserve has maintained careful communication about its interest rate path, signaling potential cuts if inflation cools further. The Treasury Department has adjusted auction sizes and maturities to better match demand patterns. International dialogue with China has continued through economic working groups and high-level meetings seeking to manage tensions. Diversification by other central banks, including increases in gold holdings, has helped absorb some Treasury supply. But challenges persist on both sides. U.S. debt ceiling debates create periodic uncertainty and political brinkmanship. Geopolitical tensions over technology, trade, and territorial issues limit the scope for cooperation. China's push for technological self-reliance and alternative payment systems adds another layer of complexity. This brings us to the most thought-provoking part of the story: the modern parallels that make the situation unique in scale, context, and potential long-term implications. The 2008 financial crisis saw liquidity freeze globally as subprime mortgages collapsed and banks stopped lending to each other. Foreign holders like China actually increased their purchases of U.S. Treasuries as a safe haven asset, helping to keep American borrowing costs low amid massive bailouts and stimulus programs. The Federal Reserve's quantitative easing initiative bought trillions in bonds, providing direct support to liquidity. The 2018 trade war caused some Treasury sales in response to tariffs, but the overall impact was contained because the Fed was still in an accommodative stance and other buyers stepped in readily. 2025 is different in several key ways. U.S. gross debt levels are much higher as a percentage of GDP than in previous episodes. Annual deficits are structural rather than temporary responses to crises. The Federal Reserve has ended its quantitative easing programs and normalized interest rates to combat persistent inflation. Foreign holdings of Treasuries, as a percentage of total outstanding debt, are declining gradually. China's reduction is part of a broader diversification strategy that includes significantly increasing gold reserves and promoting the yuan in international trade and settlement. These shifts are happening against a backdrop of heightened geopolitical tensions and technological competition. The data highlights the ongoing trends in detail. U.S. gross debt exceeds $38 trillion as of late 2025. Annual interest payments on the debt are approaching $1 trillion, consuming a growing share of the federal budget. China's Treasury holdings have fallen to $688 billion, the lowest level since 2008. Foreign holdings overall represent a smaller share of total outstanding Treasuries compared to a decade ago. Yields on 10-year Treasuries have averaged 4 to 5% in 2025, significantly higher than the near-zero levels of the pandemic era. Bank reserves remain adequate, but are monitored closely by regulators for signs of stress. Repeating patterns are visible in market behavior over time. Gradual sales by a major holder lead to modestly higher yields. Higher yields increase borrowing costs for government and corporations. Increased costs feed into broader economic growth concerns and investment decisions. But different from past crises, no single trigger event, like a bank failure or housing collapse. Gradual adjustment in reserve management rather than panic selling. Patterns from economic interdependence are clear. When one major player diversifies its holdings, it affects the demand-supply balance for the asset in question. Liquidity conditions adjust accordingly through price mechanisms, in this case, yields. But crises are rare when changes are managed and gradual. Different driver this time, strategic diversification rather than forced selling. China has maintained a measured pace, avoiding sharp moves that could destabilize its own markets or provoke stronger retaliation. Patterns from global reserve management history show that central banks routinely adjust holdings based on economic needs and risk assessments. Shocks are more likely when changes are sudden or coincide with other stressors. Experts offer a range of views on the situation. Treasury Secretary Janet Yellen has emphasized the need for sustainable fiscal paths in the U.S., while acknowledging that foreign demand for treasuries remains strong overall. Chinese officials describe diversification as prudent reserve management in line with global trends. Reports from the International Monetary Fund note potential risks from high debt levels, but stop short of predicting an immediate crisis. Independent economists highlight the importance of monitoring foreign holdings, but point out that domestic buyers and other foreign investors have absorbed supply so far. So, what does this mean for U.S. liquidity and the global economy in the coming years? Here are 3 clear takeaways from 2025's developments. First, monitor foreign holdings closely. Changes by major players like China can affect borrowing costs and market conditions, even when gradual. Second, diversify funding sources for government debt. Reducing reliance on any single buyer or group enhances resilience against shifts in demand. Third, geopolitical factors increasingly influence economic outcomes. Trade policies, technology restrictions, and strategic decisions have financial ripple effects that extend beyond immediate trade flows. One open-ended thought lingers. If diversification trends continue across multiple major holders, and U.S. deficits remain elevated without corresponding adjustments, how will markets adapt in the medium term? Higher sustained yields, slower economic growth, or new sources of demand emerging to fill the gap? China's Treasury adjustments in 2025 reflect evolving global finance, a shift toward diversification meeting high debt levels in the world's largest economy. Monitoring these trends and their interactions helps navigate the future with greater clarity. If this analysis has provided useful context on the situation, hit that like button. Subscribe for more in-depth economic updates. And comment below, what do you think the long-term impact of China's diversification will be on U.S. borrowing costs? I read every comment. Thanks for watching. Stay informed about these important developments, and I'll see you in the next one.